Because what we see in the US is you're seeing that the financial conditions are tightening significantly. And that's actually been in place since 2014. So most people talk about the rate hike cycle in the US starting in December when we saw the first hike from the Federal Reserve. But the financial condition has actually been tightening ever since the summer of 2014, meaning the cost of capital for the consumers and for the businesses has been increasing in price, not decreasing, despite the policy rates maintain very low globally. So for instance, I live in one of the few countries where we have negative interest rates. You know what? I pay more for money today than I did when interest rate was positive. Because what happens is that the market-based rate may go to zero or negative, but then immediately, in order to have regulatory capital, the people who lend me money put on an additional 1%, 1.5% of fees that is really a tax for them on capital to lend out the money, because of course the regulators say, oh, hang on, a zero to negative interest rate, the financial risk you're running in lending out money is significantly higher. So we will charge you as a regulator a premium on having the ability to lend out a zero. And that, of course, where is that translated to? Exactly to the consumers. So Switzerland, Denmark, Japan, we're actually seeing higher funding costs all in than we did when we had positive interest rates, which is kind of interesting and totally contrary to what people actually think is happening. Most people ask you, oh, you live in Denmark, oh, so you actually get paid to have your house. No, I don't. I still pay 1.5% to have my mortgage. So that's number one. And I think the recession in the US will be based on the fact that Federal Reserve maintains a hawkish tilt. They want to hike rates. Having said that, when we started the year, they promised us, no, actually, they guaranteed us they were going to hike rates 4 to 5 times, and they've done zero. So, Fed is not exactly the best one to listen to when you look at the future. I will actually argue I have a doc who is better at predicting the US economy than Fed, but that's another story. But Fed is still telling us we will hike rates. We see the long-term rate of 2.5% from less than 0.5% now. So the monetary projection is higher. The financial condition is tightening because of the regulation. And the lower we go in interest rate, the regular capital needed is going to be higher and higher, creating the burden on the banks to have less and less return. But the most important aspect is actually that Fed hiking and a flat yield curve is a tax on the banking system. If you think about it, the business of being a bank is taking euro and mine deposits at close to zero and lending it out to corporation and mortgage lenders at 10, 15 years. When that yield curve difference in the US right now at 85 basis points, there's very little room to lose money to the clients. If Fed then continues to hike short-term interest rate, of course the curve will flatten even further. That is directly and indirectly a tax on the bank's ability to make money, to secure capital and make return on equity, which means that you have a bit less ability of society to continue to service the debt and create credit in the system. So the monetary tightening, financial conditions, and of course, most important, the economic condition remains that the US is at less than 2% growth. And that's been this case for every single year since 2009. And it really, really pains me. Every time I have to talk to someone, they say, well, but the US is doing relatively better than everybody else. No, they're not. We have 5 or 6 countries in Europe that is growing at 5 to 6%. Australia is close to 3% growth. There's plenty of countries in the world that is outperforming the US. But the US remains sort of the benchmark that people say they're doing relatively well. No, the US is at 2/3 capacity, China is at 2/3 capacity of what they used to be, meaning the whole world impulse in terms of growth is less in a deflationary environment and with a monetary fiscal system which is rigged in the sense that it's never going to change. It's just going to be supporting servicing debt.